All right, so final topic we want to cover today is multiples and multiple valuation. And what I wanted to remind you of is that when we went through the key value drivers a few weeks ago, and we did McDonald's as an example, we talked about how, and I switched it for doing equity, but the idea was if we have no plat, growth, ROIC, and WACC, those become the key value drivers for driving multiples. And basically growth and spread are the key drivers of multiples. So the idea is that, and I'll remind you of what I said before, that ROIC is a proxy for free cash flow. Multiples are a proxy for free cash flow valuation. So when we value a company using a multiples approach, we have to get the same answer as the cash flow approach. Because again, if we change our approach, the company's value shouldn't change. We still have to explain the same value of a stock. So that's the point. That's what a multiple of earnings really represents. So in terms of the highlights of the reading on multiples, we have to understand that multiples are a parallel process to what we're doing, and it's really a shortcut. So the most common multiple for valuation purposes that you're probably going to run into in your personal lives is if you ever buy or sell a house. Because the idea is the appraisal value of a house and the way that the appraiser is going to do it. So what they're going to do when they appraise your house is they're going to look at all the houses in your neighborhood and near you that have sold in the last 6 to 12 months. And then they're going to look at the price of every sale. And then they're going to look at the square footage of every house that was sold. And they're going to divide the price by the square footage to get a price per square foot, very similar to a PE ratio. And then they're going to average them all out. So they're going to get an average price per square foot for your area for similar homes. Then they're going to ask you how many square feet you have, and then they're going to multiply that by your price per square foot, and that's the starting point of the appraisal. Okay? So what they're then going to do is they're going to adjust that price per square foot value up or down based on some factors about your house. So what are some of the factors that would affect price per square foot of your house in the appraisal process? So we kind of get the average for the area, and then what adjustments do you think the appraiser would make? Yeah. Whether it's been renovated and the condition of the house. What else would affect it? Bless you. Age of the house. What's another factor? The amount of bedrooms and the amount of bathrooms. I had a friend of mine who was looking for a house recently. It was a 4-bedroom house with 1 bathroom. Exactly. Passed on the house. That's going to hurt the value. Right? Lot size. Is it a big lot? Is it a small lot? Location. Where's the house located? Right? In DC versus also, is it on a cul-de-sac? Is it on a street? Is it on a busy street? Is it near a lake? That can all affect the value of the house. So I want you to keep that in mind when we think about multiples valuation, because multiples work the same way. So there's the cash flow side of the multiples, but then there's these other things that will affect the multiples. The other things are the non-operating items. So multiples are the cash flows adjusted up or down by the non-operating items, right? But the core of the multiple is based on 3 things. It's primarily based on ROIC, cost of capital, and growth. But it can also be influenced by tax rate, non-operating gains or losses, and capital structure. Okay? And just non-operating assets in the balance sheet in general. So non-operating items, tax rate, and what else did I just say? Capital structure. How much debt and equity you have can also affect it. Because think about it this way. I got 2 companies with the same operating performance. One has no debt, the other has debt. It's going to change their earnings per share and therefore change their PE multiple, even though the operating performance of the business could be the same. So those things will distort multiples. So here's the good news, bad news about multiples. One reason why people like multiples is because, unlike what we just did with the cash flow valuation, we start with the premise of our assumptions lead to a price. With a multiples analysis, you start with a price. You start with the real price, and then you work backwards. So that's why people like multiples, because we're no longer academic, we're no longer figuring out assumptions, we're very real, and there's actual prices for assets that are paid. So that's one of the reasons why multiples are popular. The other reason is that they're easy and can be used to value public or private companies. Because if I'm a private company, I can look at the value of similarly traded public companies and get a price. So for example, we just had to do a 403 valuation for the company that I own. It cost us $3,500, and it's annoying because I could do it myself. But I'm not registered with the IRS to do it, and I have an internal conflict of interest. So you might say, what is a 403 valuation? So we're giving stock options out for a private company. Well, in order for the stock options to be non-taxable to the employee, they have to be issued at fair market value. So I had to hire somebody in to come up with a fair market value for my small business that is not publicly traded. So what did they do? What do you think they did? They did comps. And how do you think they did the comps? They found public peer companies, and they said, what are your sales? And what is the price of the companies relative to the sales? And then they said, what are your sales? They took the price to sales. They said, okay, here's your price based on the sales, price to sales ratio, enterprise value to sales. Then they said, what is your profits? And what are the prices of those companies relative to profits? Enterprise value to EBITDA. That's the enterprise value to EBITDA of the market. That should be your company. What's the PE ratio? What's the price divided by earnings per share? What's your earnings per share forecast? There's your PE ratio. So basically, they just did a bunch of multiples. They averaged the multiples. They used the mid-range of the multiples, and they said that's the value for the company that we're writing on a piece of paper and giving to the IRS. And I paid $3,500 for that. Right? That's what I'm saying. I could have done it myself, but as I said, I have a conflict of interest. But I knew exactly what they were going to do. So I even knew before they started a general idea other than what comp set are they going to use. So what peers are they going to use is going to matter to my multiple valuation. Ironically, when you do the valuation I did, what I want are the bad peers, not the good peers. I want the poor performing peers. Why? I want my employees to get the lowest possible stock option value if it's incentive compensation, so I actually want the peer set to have terrible multiples. I don't want the peer set to have good multiples. By the way, if the IRS is listening to this, I did not have any influence over the peer set. Okay? Take it up with the company that I paid the money to. So, back to this. So that becomes key, though, is what range of companies that we pick is going to have a big influence on the multiples analysis that we do. And that's one of the harder things to do in multiple analysis. So one of the challenges we're going to run into is finding a fair range of companies, which means I also can't just look at competitors. I have to think about size. One of the problems I have with evaluation of some of these social networking companies is they're comparing themselves with Facebook and Google. Well, the problem with Google is they're a very profitable, mature company. And when you're a startup that doesn't have any revenue or any baseline, then using the same multiple for a startup and established company is almost kind of cheating, yet people will do that. So that's why we have to kind of think about what we're actually making comparisons to and try and do fair comparisons. And as simple as that sounds, in the real world, that is really, really hard to do. And one of the common examples I often use is I work with a company called Ingersoll Rand. And Ingersoll Rand makes 3 businesses. We talked about this before, didn't we? Who are the 3 businesses of Ingersoll Rand?
Tractors or something.
They make Train is their brand for air conditioning, heating equipment. So Train is their biggest part of their business. They also make club car golf carts, and they make security locks. They have a security business. So locks, golf carts, and air conditioners. But their biggest part is commercial residential air conditioning and heating and air conditioning. All right. Who do you think the biggest competitor for Train, which is owned by Ingersoll Rand, is in the heating and air conditioner market? Anybody know? The brand? It's called Carrier. Anybody know who owns Carrier?
They don't do industrial.
They're industrial, but you know who owns them? They're owned by United Technologies. They're about a quarter of United Technologies' business. So we're comparing 60% of Ingersoll Rand's business with 25% of United Technologies' business. By the way, the other 75% is Sikorsky Helicopter, Pratt & Whitney jet engines, and Otis Elevator. That's United Technologies. So I'm comparing those two companies. Those are peers. Those are comparables. Everybody see the problem there? That's unfortunately the other challenge we run into in the real world, is finding a true peer that does the exact same thing outside of an academic setting is next to impossible. Because in today's world, people now have multiple business segments and they do different things. So for example, who is Starbucks' biggest peer?
McDonald's.
It's McDonald's. That's the comp Wall Street uses, McDonald's. They do the same thing?
No.
They're both fast food. There's the peer set. But they are compared with Dunkin' Donuts as well. And they're compared with Wendy's. And they're compared with Panera. And they're compared with Chipotle. That's the peer set. So what I'm telling you is, this is the messy part of multiples, because we're trying to find businesses that do similar things, so it's hard to do it on their actual lines of business. So we have to look through this and we have to say, what are we really looking for? We're looking for those three things. We're looking for similarities of growth prospects, similarities of ROIC, and similarities of risk. That's what becomes important when we find the peers. So if I can find people that do similar things, that have similar operating risks, that have similar levels of growth, or at least size, and similar levels of return, that's what's more important to the peer set, because we're probably not going to find a pure peer-on-peer comparison. Sometimes I can get lucky. Royal Caribbean. Who's their biggest peer? Carnival. Both of them only do cruising. So that's nice, but that's the problem. That's the entire peer set. Right? Because the next biggest cruise line is owned by who? It's a subsidiary of Disney. Well, guess what? Disney does a lot of other things besides cruising. But when I start putting Disney in as a peer to Royal Caribbean Carnival, it starts making my numbers look far different. So again, that's the challenge we have with multiples. The good news is they're easy. The bad news is they're easy. So how do we actually do the multiple analysis? First, we got to find, and as I said, this sounds simple, but this is actually probably the most important part, find the similar peers. Find the peer set. Then, next part, need the forward numbers, because companies are based on forward cash flows, not historical cash flows, so we do forward multiples. They matter more. Then, we calculate the multiples, that's the easy part, and then we kind of try and explain them. So, how do we do this? This is Bloomberg. So, let's go back to Coke. One of the screens in Bloomberg that you will use is called RV. Stands for Relative Valuation. This is the screen that allows you to compare one company across a series of others. So it initially starts out when you go here to the GICS peers. What's that? The Global Industry Classification Service. So those are the standard peer group. I forget what company does this. Is it Standard & Poor's or somebody like that? So some company actually publishes this based on the government data. But basically, these are the standardized company groups. Then, that's not the peer group we're going to use. In Bloomberg, under Comp Source, we can switch to Bloomberg peers. And this is a curated list. So what Bloomberg does is they go through the Global Industry Classification Service, and somebody manually says, these companies don't make sense, and they take them out. So they come up with a curated list. So again, you can argue whether or not this is the final list we can use, but here's the nice feature of Bloomberg. If you don't like the list, you come down here to edit, and then you can get rid of. So let's say I want to get rid of Beam. So I uncheck Beam, save. I've customized the segment, yes, Beam is now gone, and it creates a custom set of peers. So I can also create my own list. Same thing, I can edit a peer, and I want to put in, I don't know, pick a company, Walmart, that I want to add as a peer. Not saying you should, but you could. And now Walmart's part of my custom peer group. Okay, so I can edit my own list if I don't like it. For our purposes, we're going to use, for your exercise, I'd start with the Bloomberg peers. And over here, it defaults to countries of domicile, which basically means since Coke is headquartered in the U.S., these are U.S. peers. If I wanted to, I could switch this to global peers, and then that would be Coke's global peers if I wanted to use a global list. Right? For purposes of your assignment, to keep it a little bit simpler, we'll just say for your pharmaceutical peers, why don't you just use the U.S. peers, okay, country or domicile, rather than making it more complex and throwing in a bunch of global peers. If you want to make it more complex, have at it, but it's acceptable for your group project to do region of domicile, but I do want you to start out with the Bloomberg peers. Okay? Now, here's the thing. In this class, I'm going to hold you accountable for knowing these 6 multiples. These are the 6 multiples that we're going to calculate and have to explain. There's 3 enterprise value ratios. The first is enterprise value to sales, EV's enterprise value. Enterprise value to EBITDA, enterprise value to EBIT. They are just as they sound. How much am I willing to pay, enterprise value, for every dollar of sales? Enterprise value to EBITDA. How much am I willing to pay, enterprise value, for every dollar of EBITDA? And the third is, how much am I willing to pay for every dollar of EBIT? Okay? So those are the first 3 ratios. Enterprise value to sales tends to be more influenced by profit margin. Think about what all these enterprise value ratios are trying to eventually get to. It's trying to get to our free cash flow valuation. So what you're really trying to say is, how do sales explain future free cash flows? Well, given the choice between the 3, and we just talked about free cash flows earlier, we did the ratios tab, what did we say matters most when we said the ratios to change earlier today? Revenue growth rate and EBITDA margin. So if you think about it, enterprise value to EBITDA is probably the most important of these 3 ratios from an analyst standpoint, because EBITDA is the closest proxy for gross cash flow. Right? But the problem with enterprise value to EBITDA is it doesn't tell you about gross investment. So what you're really saying is value relative to cash flow. So obviously, if a company doesn't invest a lot of its cash flow, it's going to have a higher enterprise value to EBITDA than a company that reinvests a lot of its cash flow, lower enterprise value to EBITDA, because it's going to have lower free cash flow. But nonetheless, the practitioners tend to like enterprise value to EBITDA more. And here's the thing. If the companies maintain a steady amount of investment year over year over year, then enterprise value to EBIT. Because what they'll do is they'll treat the DA as cash. So if you treat the depreciation as cash reinvestment, you get EBIT. And so therefore, you can say that EBIT is your proxy for free cash flow. If the cash flow reinvestment isn't the same year by year by year, or if it's lumpy, then enterprise value to EBITDA, and then you just have to recognize that the EBITDAs will then vary based on future expected reinvestments. Enterprise value to sales is probably your 3rd best option of the 3, because enterprise value to sales doesn't tell anything about profit, doesn't tell anything about reinvestment. So the reason you use enterprise value to sales would be what?
Companies that don't have earnings.
That's right. If you don't have any earnings or track record of earnings, use enterprise value to sales. So if I'm valuing Snapchat, enterprise value to sales. I'm going to, or when Mark Zuckerberg valued WhatsApp, it was 19 times next year's sales, not earnings, right? And again, how those sales translate into earnings, that's where I come up with the idea of a 19 times multiples. And as I said, in the short run, what makes enterprise value to sales different amongst companies is margins. Companies with higher margins are assumed to get more enterprise value to sales because they should theoretically generate more what? because they're going to get more EBITDA and therefore more free cash flow. So the most important sensitivity to EV to sales is margin. So those are the first three ratios. Ratio number 4 is price to earnings ratio. Price per share divided by earnings per share. Here's the thing about PE. Even though PE is the most commonly used ratio out there, it's the one reported in the press, it's the one people like to use. PE is the hardest ratio to explain. Think about it. I'll draw it on the wall here. I'm assuming these are not permanent markers. They put them on the wall, so you guys saw they were sitting right here. Sales minus operating expenses equals EBITDA. Minus DA equals EBIT. Minus interest minus non-operating items minus tax equals net income. When you do enterprise value to EBITDA, it's much cleaner than when you do earnings per share, because earnings per share is influenced by operating expenses, it's influenced by depreciation rates, it's influenced by interest, finance charges, capital structure, it's influenced by the non-operating gains and losses, it's also influenced by the tax structure of the firm. So what I'm saying is, it's actually a 6-factor analysis to do a PE ratio. So even though it seems the easiest of the ratios, because it's clean, it's just net income relative to shares and to market value of the company divided by shares, seems clean, price per share, earnings per share, it's actually the hardest to explain because more factors go into net income. So that's why, again, the pros like the enterprise value multiples, because it's not saying those other things don't influence it, they just don't tend to influence the actual ratio as much. And that's what I'm saying, is that it's usually a cleaner ratio, because here's the underlying assumption to all of these multiples. We assume that within an industry, tax rates are similar, so tax rate is not a differentiating factor. We assume the capital structures are similar, so interest is not a differentiating factor. We assume that non-operating gains and losses don't really occur regularly, so that's not a differentiating factor. We assume that people are making similar reinvestment rates, so depreciation is not a factor. So what really matters is enterprise sales and EBITDA, which really is another way of saying ROIC, growth, and cost of capital. But here's the thing, cost of capital should be similar. Risk profiles are similar across the industry because we chose similar peers, so really it's ROIC and growth. So we've just made a whole bunch of assumptions, but that's the starting point for multiple analysis, is those assumptions play out. So here's how we then check the assumptions with the final two ratios. Price to book ratio. Price to book is similar to market value added. What does a price to book of 1 mean? Price per share divided by book value per share.
Company basically isn't creating any value.
That's right. Therefore, their EVA or EP should be what?
They're
EP would be 0.
Yeah.
right.
And why would the EP be 0? What about their ROIC, could we say? EP 0 because ROIC what?
Equal to the WACC.
Equal to our WACC. We're not creating any value. What would cause a positive economic profit?
Higher ROIC, that's right.
Positive spread, right?
That's all.
Therefore, what does a price to book tell us? In theory.
Spread.
Spread. Price to book is a proxy for the spread. That's why we like the price to book ratio. Here's the problem. In theory, that works out. The problem is AOCI adjustments. The problem is one-time write-offs. Because when a company writes off its equity, it wipes out the equity, but it's one time, it's non-recurring. So I have a whole lot less equity, and it doesn't change my cash flows in the future. Well, guess what? I get a high price with little equity, I get a great price to book. It doesn't necessarily mean I'm a better firm, it just means the accountants adjusted the equity of the balance sheet. So the one problem with the price to book ratio is it's often a dirty ratio. And what I mean by dirty is it's been adjusted many times. Yes?
But but that same will hold for the ROIC?
Could as well.
Right, so.
Could as well.
Doesn't matter.
Yep. But I'm telling you the price to book is going to be more sensitive to it. Yes?
The book described the pitfall of using EBITDA because depreciation can sometimes overstate and understate.
That's right.
investment.
So that's why what we're actually going to do is we're going to look at these in totality. So we're not going to rely on one individual ratio. It's really what all of these ratios tell us. That's a really good point. But nonetheless, I'll give you an example of this. So take Lockheed Martin. And I'll go to RV and I will go to the multiples. Just as an example, if I look at Lockheed Martin, their price to book ratio is 10.68 in an industry that's 5.59. And one of the reasons why their price to book is so high goes back to 2008. When the stock market crashed in 2008, Lockheed Martin has a huge pension liability because they've been around since the 30s and 40s as Lockheed and some of their other companies they bought. So because they have a giant pension liability, they had a bunch of pension assets. And their pension assets lost a lot of value. So what did the accountants make them do? They had to write it off on their balance sheet. So they had to say that our pension assets lost a bunch of value, so they wrote it down. And then they wrote it down, they wrote off the pension assets. What was the corresponding line of liability and equity they had to get written down? Equity. They had to wipe out the equity to wipe out the pension assets. So they wiped out a bunch of equity in 2009. And so here's the thing. Since 2009, stock market's more than recovered, and we're now hitting all-time highs. But guess what the accountants won't let them do? Can't write up the pension asset value. They're still at the book value of 2009. So here's the problem. They have this distorted price to book ratio because of arbitrary accounting rules, because they're not doing mark-to-market accounting. So that's what I'm telling you. You got to be careful because this ratio, more than any of the others, is subject to those types of distortions. So ideally, it tells you whether a company has a positive spread, but not always because of these accounting adjustments that people make. That leads to ratio number 6, PEG. Price to earnings ratio divided by the growth rate, right? If we assume that ROIC and growth are key to value, assuming similar cost of capitals, then PEG tells us how much I'm willing to pay for every unit of growth. Why would I pay more for growth?
Well, because one of two key factors relevant to the value.
What are the two key factors?
ROIC and growth.
Yeah, if growth is embedded in the equation, then the other factor is ROIC. So therefore, the PEG ratio is probably the cleanest ratio of explaining ROIC. Assuming that these companies have similar risks, and assuming these companies don't have a lot of non-operating items, then the PEG ratio basically gives you the ROIC, or the expected ROIC, and that's the key. It's all expectations. So PEG is an indicator of expected ROIC. High PEG, why do I pay a lot more for the growth? I pay more for the growth because that growth will turn into more free cash flow. Why will it turn into more free cash flow? Because I have higher expected ROIC. Low PEG, why do I pay less for somebody's growth? Because it's not going to generate a lot of free cash flow because they're not going to earn a good return on that growth, and therefore low PEG. So PEG is the cleanest of the ratio, again, subject to accounting abnormalities. So that's the theoretical answer, but as I said, we have to be careful, but I'm telling you, PEG tends to be cleaner than price to book. So usually the two should tell you the same thing, but if they ever disagree, and if I had to choose, I'd more likely choose PEG than price to book as my tiebreaker if they have conflicting answers, because price to book is more often distorted, but not always. There's always exceptions to every rule. So here's the thing. In Bloomberg, this is what you're going to do. So we'll go back to Coke, U.S. equity, and I'll go back to the RV screen. So in Bloomberg, there's a tab called Custom. The advantage of the Custom tab is I can very quickly put in whatever ratios that I want to use to compare against my peers. So in this case, for Coke, I'll use Bloomberg peers, region of domicile, so I'm just using US peers. Even though Coke's a global company, I'm just doing this to keep it simple for us. Not saying that we wouldn't want to add their global peers. But then here's the thing, in add column, I can add any ratio that I want. In this case, I'm going to add these multiples because Bloomberg is already tracking these. So I'll start out with enterprise value to sales. So I start typing in EVTO space SALES, enterprise value to sales. And you'll see that Bloomberg already has two ratios already tracked in their database because these are pretty commonly used. EV to this year's sales, EV to next year's sales. This year's estimated sales, think 2014, year one. This EV to next year's sales, year two. What did the book say was more important? Year two. So year two's forward numbers are more normalized than year one, so that's going to be the more important number, right? So here's the thing. In the interest of time, rather than putting 12 ratios in, we're just going to put in 6 ratios. We're just going to use the second year's normalized numbers. But if you want to put in year one, year two, you can put in both, right? So I'm going to use EV to next year's sales. Hit enter. There they are. Okay. I can also granularly calculate it by going through the screens and figuring it out, but as I said, why? You got this great tool, let it do the math for you. Next, EV to EBITDA. Again, EV to next year estimated EBITDA. Already a ratio. Done. Third ratio, EV to EBIT. Show more matches. Come here down to the bottom, and I look for EV to,
Bottom.
thank you, next year's EBIT. And by the way, it'll give you the calculation over here. The formula's always there. Select that. Next, we have price to earnings. So just type in P/E. And again, we have my estimated next year's PE ratio, 2015 PE, right there. Next, we have the price to book ratio. And then it's going to ask me which one do I want. Okay. Now, here's the thing. I'm going to use for price to book the current price to book. Okay? Because theoretically, the current price to book is the current price, right, against the current earnings per share. Actually, take it back. I don't want to use that. Edit column. I want to use the customized period, and I want to do the price to earnings based on fiscal year, and I want to do it based on 2 years forward. Actually, it's not going to have that one. We'll just use the current. Call it price to book. Finally, we need the PEG ratio. PEG. And again, I want the PEG ratio next year. So there's my 6 ratios. Right? Finally, select stats, market cap weighted average. Because that's going to then weight these based on the size of the firms. So that way the small firms, which could have really distorted ratios, do not impact my industry average nearly as much as the big firms. So now I have my industry average for the ratios. Final ratio that I'm going to use in here, forgot about this one, something called the long-term growth rate, LTG. And in this case, I have my best estimated long-term growth rate. Now, BEST, by the way, stands for Bloomberg Estimate. It's the consensus of the analysts. And here's what's key. On Wall Street, when they estimate long-term growth, what they're actually doing is they're estimating growth in earnings per share. Specifically, it's a 5-year growth in earnings per share. So it's different than RG, which is a perpetuity value of cash flow growth. So the long-term growth rate here is not the same as RG, and you don't want to use the same number because growth in earnings per share is not the same thing as growth in cash flow. However, we're going to add it to, and I'll use the from 1 day ago. So I'm going to use the most current long-term growth rate they have in their database. Why did it do this to me? LTG. There we go. I'll just use the best estimated long-term growth rate, and as I said, that's a 5-year growth rate in earnings per share. Okay? Now, here's the thing. We're going to use it as a proxy for RG. So it's not RG, but we're going to assume that if your earnings are growing faster, then your cash flows are probably growing faster. And if your earnings are growing slower, then your cash flows are growing slower. So the whole point of the long-term growth rate being on this table is just to give us a directional proxy of the growth rates. It's not absolute, right? Now, here's the reason why this matters. When you do your multiple analysis, so this is the final section of your group project and paper. So there's 4 sections. Section 1 is EIC. Section 2 is historical analysis, the CFI and the ROIC tree. Section 3 is the multiples. Section 4 is the valuation, right? So this is the final section that we're covering of the group project. As of today, we've now covered all the sections of the group project. Here's what I want you to do. For your company, I want you to do an average of the Bloomberg peers of the country of domicile as a starting point. If you want to go global, be adventurous, you can. But what I want you to do, you can come up here and you can output to Excel if you want it, or you can save this as a screenshot. And more importantly, the nice thing is you can also save this as a template. So I would call this something like 760 mult. And the reason why that's important is that if I go to any company, I don't know, let's do Tesla, and I go to RV, and I go to custom, and I go to 760 multiples, then voila, there's all the multiples for Tesla and its peers. Okay. So again, if I save as a template, it makes it very reusable. I can reuse it with those fields. So back to this, I'm going to go back to our Coke example. RV, custom, multiples, select stats, market cap weighted average, update, and I will hide the top section. So for your company, I want you to explain why it's trading at a discount or a premium. Discount means below the industry average. Premium means above the industry average. So is Coke trading at a discount or a premium? We would say it's trading at a premium. Okay. Now let's go back to the core of multiples. What matters to multiples? Spread and growth. What can we say about the cost of capital of these companies? Or what should we be able to say?
They're all the same.
They should be similar. Therefore, we'll call them the same. So that should not be the differentiating factor. So the differentiating factor should be the ROIC and the growth rate. So here's the thing. We have a proxy for the growth rate. So we know 2 of the 3 factors. We know the multiple. We know the growth rate. What are we missing? Or specifically, expected ROIC. Here's the other thing. The expected ROIC could be different than the historical ROIC, because that's what we're really trying to understand in the multiples. So, what can we say about Coke? Coke has what in terms of its growth?
Below average expected growth.
Therefore, it must have. Does that explain this? Enterprise value to sales, I pay $4 for every dollar of sales of Coke versus $2.40 for the industry. That makes sense. Pay more for Coke sales. Probably because if I did an EBITDA calculation, Coke probably makes more EBITDA than everybody else. Enterprise value to EBIT, I pay more. That makes sense. Enterprise value to EBITDA, pay more. PE, I pay more. Price to book, it's worth more. PEG, higher ratio. It's clean. Coke's easy. Right? Now, unless I pull out the key value driver formula and start plugging in numbers, figuring out the exact reason for that multiple is a little bit more challenging. But what I really want you to start to understand is just what we did. Why is it trading at a premium or discount to its peers? So, pick another company. How about Coca-Cola Enterprises? That's the bottlers. This is the largest bottler of Coca-Cola in the United States. They're independent of Coke, and they're publicly traded. So it's not the people that make the syrup. So basically, Coke ships the syrup to the bottler actually bottles it and distributes. So if you see a Coke truck driving around, they work for Coca-Cola Enterprises. They don't work for Coke, the corporation. Right? So Coca-Cola Enterprises. Why? What can we say about their multiples and why? Premium or discount? Discount? So we're looking at this one. Discount? Lower, 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 higher, lower, growth rate, higher. So, what would explain a higher growth rate and lower multiples?
Negative spread.
Do they have a negative spread? How can we tell that they likely have a positive spread?
Because their price to book is.
Their price to book is above 1. So it's not a negative spread, it would be, what can we say about their spread? Smaller spread. So Coca-Cola Enterprises probably has a smaller spread, therefore lower expected ROIC than both Coke and its peers. Think about Coca-Cola Enterprises. They have, the bottlers, a bunch of plants. They hold all the inventory, right? They hold all the assets. Coke is the secret recipe, and they basically sell you the formula for the syrup and they rent you their brand. That's Coke Atlanta. That's the corporate parent. The bottlers own all the assets. If you think about the business models themselves, which one is likely to have the higher ROIC? The parent. And that's what we see here in the multiples. That's why you don't pay as much for the bottlers as you do the parent. That, by the way, was the genius of a guy named Roberto Goizueta, is that when he took over Coke in the 80s, he became famous and made a lot of money because what he did is he took every conceivable asset owned by the parent and he shoved it on the bottlers. And the bottlers to this day are bitter about that because it killed their returns on investment. And the bottlers, which had historically done very well, started doing a lot less well because they ended up with all the assets. And they're in a tougher margin business than Coke itself. So he actually, to some degree, set up Coke structurally to be far more profitable on a go-forward basis. And we could see that. If we looked at the same EBITDAs for the bottlers, they're much lower than they would be at Coke, the parent, which we just did the valuation on. They don't get the 30% EBITDAs. They get much lower EBITDAs because it's a tougher business, and they have all the assets, lower return on investment. But you see that show up in the multiples. And that's the point. The market is pricing it that way because they're realizing you're not going to get as much cash flow. Now here's the important one. Pepsi, competitor number one. What can we say about Pepsi relative to the market? Premium or discount?
Premium.
To the market. Premium? So a little bit lower enterprise value to sales, a little bit higher, but not much. A little bit higher, a little bit higher, a little bit higher, a little bit higher, a little bit lower. So Pepsi also has slightly lower growth and probably higher than average ROIC to trade at a little bit of premium. Yes?
Yes.
Okay. So, here's the thing. Coke versus Pepsi. Who's got the higher ROIC? And how can we tell?
Pepsi. Because they have a higher.
Not Enterprises, but Coke, the parent, just making sure. So Coca-Cola Company, line 100 versus Pepsi.
Pepsi has a higher price of book.
Pepsi has a higher price to book. But,
Probably Coke because of the best to long-term growth. PEG.
but think about this. If you look at the PEG, I'm paying $2.58 for every dollar of long-term growth versus a Pepsi, I'm only paying $1.57 for every dollar of growth. So I'm paying more for the growth.
253.
Sorry.
But yeah.
258 versus 253. Paying slightly more. Sorry, I was looking at the wrong one. But here's the real differentiating factor. I'm paying slightly more for about the same growth, 7.2 versus 7.3. But notice that Coke's enterprise value to EBITDA and EBIT, and to some degree enterprise value to sales, are substantially higher than Pepsi's. 17 versus 14. 14.5 versus 11.5. 4 versus 2. So when I look at the totality of the ratios, it suggests to me that I think Coke is probably higher than Pepsi in expected ROIC, right? But here's the interesting thing. The PEG, the price to book ratio, does not say that, right? And that's what I'm telling you. Sometimes these ratios can conflict, and then we have to kind of make our own judgment as to what could explain that. And I'll go back to, we already talked about how Coke could be distorted in the price to book ratio. And I think that's probably what's happening here, is you're seeing some distortions in either Pepsi's or Coke's price to book ratio, probably because of write-offs at some point in the past. And so therefore, I don't think the price to book is a true, clean indicator of true spread. So this process is the one that I'm gonna need you guys to go through, right? As part of your upcoming homework assignment. Right? So here's what I'm gonna do for your homework assignment. So let's pick somebody else. Another company, another industry.
HP.
Hewlett Packard?
You have starting back too?
Yeah.
All right, so we'll go to HP, which is HPQ, is their ticker symbol. And here's the thing. If I go to FA and I go to IS, then this is their income statement, which we would then output to Excel. Yes. I would then select all, copy, paste special, values, OK. Then I would Control F, pound, N/A, N/A, replace all my NAs with zeros. So file, save as, we'll call this as an Excel workbook, HPIS. Right? Then I'm going to go to the balance sheet and do the same thing. Output to Excel. Got to go back to here. Okay. Copy, paste special values. File, save as. HPPS. And do I see any NAs in here? Actually, I don't even see any NAs. That's good. I'll have to replace those. And finally, their cash flow statement. Output Excel. And I now have the three major financial statements for Hewlett-Packard. And again, I see a few NAs in here, although let's change them. So I have my three financial statements. What is this? HPCF. Then I go to Bloomberg. I then do my DES for HP because that would have the shares outstanding. HP DES. I would then go to the weighted average cost of capital because that's the discount rate that we're going to use. I go to the earnings estimate overview screen on an annualized basis because that's going to be the important data for sales and EBITDA. HP-EEO. And I go to the RV screen, and this is my custom template for HP and its peers that we've just created. Select stats, market cap weighted average. And we're going to use Bloomberg peers, country of domicile. Okay, so those are the 4 screenshots and 3 data files that you will need to do your homework assignment. So here's your homework assignment for next week. So using the Excel model that we created today, you need to do an as-is and a final valuation of HP. Okay, so you got to put in all the data and do the as-is, and you got to then create a buy, sell, hold, and come up with your final valuation. And then I'm just going to ask for basically just write up, I'll leave 2 text boxes, a paragraph on the whys, like just simple rationales. You don't have to be too lengthy on this one. But this is process practice for your paper. Because in the paper, you're looking at a 12-page write-up. Each section's about 3 pages. So in the paper, for your group project, 3 pages. Right? For homework, paragraph each. Okay, just to keep it simple. So I'm going to ask you to do that. Third part of the homework assignment is on the multiples. I want you to tell me if HP is trading at a premium or a discount and why. Using the multiples. And then I want you to compare HP to at least 2 other companies, just like we did. Pick 2 other companies and explain why those companies are trading at a premium or discount to the market and to HP, using ROIC growth and the multiples, just like we just did for Coke. So that's your multiples part of the assignment. So those are the 3 things that you'll have to turn in. So basically an Excel file for your as-is valuation, an Excel file for your final valuation of HP, brief write-up on the assumptions, which will just be a text box or a Word document, and then a write-up on the multiples for HP, premium or discount, why, premium or discount to competitors, why to the industry, and then to some degree, rank the ROICs. So 1, 2, 3. Who's the highest amongst these 3? Who's middle? Who's low? So you're getting a ranking of expected ROIC. That's what I want you guys to do before next 2 Saturdays from now. Next Saturday is 4th of July weekend. We have no class next week. Questions?
Use that list. I mean, like, is Apple really
Well, for this purpose of this assignment, we're going to use the Bloomberg curated list, but I think you bring up a good question, which is Apple truly a competitor of HP? There's probably arguments for and against. I mean, essentially, the hardware side of HP, they make computers. Apple still makes some computers. Increasingly, Apple's mobile technology and HP is outsourcing. But I would say that the market is using Apple as a peer of HP, for better or for worse. So if I wanted to, I could come out here instead of whole firm, I could say information technology, and then I could compare HP against its IT peers if I wanted to be more granular. Right? Now, by the way, this is all of HP. It doesn't break out just the IT part of HP, but against people that are more IT related. For purposes of this assignment, since we're just practicing the process, we'll keep it at the whole firm level. But, because again, what I'm really trying to say is, if you did Apple, you're probably going to say Apple has a much higher expected ROIC than HP. Right? But nonetheless, you probably rank them higher. But it's still process-wise, we can practice this. If you want to be more granular for your Pfizer Merck assignment, you're welcome to do so. Right? Other questions about the assignment?
So the due date is what? The week?
The due date is going to be 2 weeks from today. Right? Now, here's the other thing. So, questions about this before I stop the video? Because all this is on video, so you'll have the explanation. But the due date, 2 weeks today before the start of class. So 8 a.m. is the time we've been using to submit. Right? Now, what I'm going to do as well, so you can either go try and get this data out of Bloomberg, but the reason why I just downloaded it all is I'm going to create a folder on Canvas with all of this data. Just because I know many of you don't have access to Bloomberg outside of here. So basically, I'll give you this data